Hi everyone. Today we have an exclusive session for AssetPlus advisors and investors with one of the fastest growing fund houses in India, Axis Mutual Fund. We will be having a conversation today with Mr. Anupam Tiwari, who is the fund manager of Axis Smallcap Fund. So to introduce Anupam, he is a popular name in the mutual fund industry, a chartered accountant by profession. Anupam has over 10 years of experience in the equity asset class and has an excellent understanding of various sectors and companies. He follows a bottom up approach of research and stock selection, and he has previously worked with Principal AMC, Reliance AMC, to name a few. So, thank you for joining us today, Anupam.
Yeah, hi, most welcome.
Yeah,
Thanks for having me here.
yeah, it's a pleasure, Anupam. Thank you. So, for the format of the session, before we actually have a set of questions that our advisors and investors have specifically asked. So, prior to moving ahead with that, could you please set a context by providing a rough market overview from your end?
Thanks again for inviting me for this session. We know that now, country up, and even if you look in Europe and in US, number of in terms of in new cases growth rate is coming. So case number of cases are kind of so flattening of curve is happening, not completely, kind of started. And there is discussion of economies in Europe and US. Uh, by mid of next month, things should be much better. Though one should keep in mind that US never had such a stringent lockdown to begin with. So it's not like India, where maybe in some part of Italy it was there. Uh, so coming back to India, we now see a fairly reasonable chance that at least in green zone and orange zones, most of the economic activity should come back by end of June. And red zone, we need to wait and watch, and containment zone, of course, will remain out of bound. So a decent amount of activity should start by end of June. One month more. Now, in terms of economic revival, uh, we believe that it may take 4 quarters at least. Certain sectors will revive pretty fast, which are like staple and more to do with consumption. The basic consumption like FMCG or pharma, etc. They will revive pretty fast, maybe by end of quarter 2. But certain sectors will take time, uh, especially where consumption happens in groups, like theater, hotels, etc. Maybe a FY21 full year for them will not be any operation at all. So they will revive maybe end of financial year. So by Q4, there would be certain segments who would be in between. So for example, banking, etc., NBFCs, they may revive somewhere in third or fourth quarter. So broadly speaking, and this is nothing shock to the market. Market knows it that it will take time for revival of the economy because uh, the problem is big and we are still not done with the problem. However, now slowly we are learning to coexist with the problem and also work. So earlier the method was that okay, don't work, but given the economic compulsion, I think now system is learning to work and also try to manage the problem, which is a good thing. So I think in 1 or 2 months we would be kind of uh, we would be pretty efficient in that. Of course, right now there is a crisis because of migrant moving out. So in some places we hear that work cannot be done, though they have permission. Factories are not operating at full capacity because migrant workers are not there. The workers have moved out. Mostly they were migrants, so they have gone back to their native places. I think this problem will remain at least for next 6 to 9 months, and only when things stabilizes, people will come back. So generally, market has kind of understood this. There have been a slight disappointment with the format of the stimulus package. Maybe market was expecting more of direct cash transfer or direct cash payment, which government has not done uh, in the number or in the size that was market's expectation. So because of that, and also given some global cues, market took it negatively. But that's okay. I think given the fiscal situation of the government, large cash transfer was anyway not a very rational thought process. So good thing is our macro dashboard is quite good. So is control, current account deficit currency, everything is kind of in a reasonably manageable bounds. From that perspective, we are not worse off, and it's not too much of physical destruction per se because death rate is very low, and so survival can be reasonably good and may not be very fast. It's not like a V-shaped recovery happen. It could be more like U-shape and slightly near bottom of U. So, but for sure recovery will happen. So for me, recovery would be an FY22 idea across the board. Till that, there would be gradual recovery. So people should expect market to remain volatile, even in let's say next 3 to 4 quarters. And good thing is that market is reasonably cheap. It's not very expensive after this fall. So and across the board, more so in small cap and mid cap. Large caps, some of the large caps have not fallen. Some have gone back. They fell and then they went back up. So market is reasonably priced. So it is good time to invest. However, there is no hurry for anybody to jump in the market in one go. They can take their time next 3 months, 6 months, and do an STP, SIP, whatever they want, and time it and have a long-term horizon. Because for sure we will overcome this problem. That is not a question mark. The question is how much time it will take, and it may take little longer time. So from that perspective, to make money from here on, one need to really have a good long-term horizon. For large cap funds, maybe 3 years. For small cap funds, 5 to 7 years. Mid cap funds, 5 years. Multi cap, 3 to 5 years. Those kind of time horizon. Because in short term, making money would be difficult. So I think from that perspective, investors should approach the market. There is no need to panic. There is no need to be uh, thinking that world has come to an end. It's not going to be like that. And one should remember that if someone gets infected by this virus and if he uh, becomes virus free after a while, then he develops a good immunity, so he cannot be infected again. So after some time, and for 80-90% of the people, nothing happens. Generally they are capable of overcoming the problem. So after some time, the population that will be kind of immune to the virus would be quite large, and hence slowly we would be able to come back to proper speed of recovery. So I think that's all from my side. Now we can take Q&A.
Sure, Anupam. So thank you for the overview. I'm sure that the audience would have found it encouraging to hear this on a positive note, because all the calls that we had taken a month or 2 months ago, that time the uncertainty was much higher. So we could not predict how long would it take. But I think you have outlined a good path to recovery over the next few quarters. That's definitely quite encouraging. So can we move ahead with the set of questions?
Sure, sure. So just one thing I would like to point out is that equity is a peculiar asset class which will give you best return if you enter at the time of worst phase. So whenever there is uncertainty, there is problem, market goes down, and if you enter at that point of time, it will give you best returns. Even if you don't invest when market has already delivered 20-30% return, it would be absolutely fine. And generally we have been saying in December, January that market is quite expensive because it has run up pretty fast. Earning growth is not catching up. So from that perspective, I think this time be confident and invest. My sincere request.
Yeah, yes, Anupam. I think this is something even we have been mentioning to investors, like not to be in a hurry to invest because the recovery would not be happening in a month or so. But given the kind of fluctuations that have happened in the markets, the prices have corrected to a relatively attractive level. So for people looking at a longer time horizon for their financial goals, this would be a good time to enter the markets. I think we would definitely second your opinion on that as well. Moving ahead with the questions, Anupam. So the first question is, so how do you expect the small cap stocks to benefit from the stimulus announced by the government? Is there anything particular that you see that will be positive, and do you see any negatives here?
Okay, so the biggest positive is the MSME credit guarantee scheme. It is designed for smaller companies. So from that perspective, it benefits a decent chunk of small cap universe, especially the lenders who are the smaller NBFCs, etc., and also companies who deal with a supply to all these small companies. So if it is implemented properly, and I believe so, without any too much of complication, because it is a fairly straightforward scheme and applicable only to existing borrowers. So you don't need to find a new borrower. You just have to give extra 20% loan to existing borrower, and that is supposed to be guaranteed by government. I think that's a very, very good thing. And anyway, all reforms, uh, any kind of improvement or tinkering with the system to increase the efficiency helps a lot of smaller companies. You know, as you make system more efficient, more fair, more transparent, smaller companies benefit more, because they don't have too much of muscle power. They don't have too much of balance sheet or money or management bandwidth to fight too many battles. You know, so if the system is fair and transparent, and it is encouraging people to do more and more business, incremental benefit comes more to smaller companies rather than large companies, because anyway large companies are doing good. you know they have good balance sheet, they have good standing, good brand, etc. So and they have capability to withstand the problem or this economic downturn, whereas smaller companies don't have. So I think overall, effort to stimulate economy, overall an effort to make economy more transparent, more fair, is something that always helps smaller companies. So from that perspective, both are good.
Okay. Thank you, Anupam. So one more question. So this is more to do with a little bit of past data. So there seems to be a trend that when markets usually come out of a recession or a deep correction, the rally first occurs in the large cap space, and then eventually there's a spillover to mid cap and then to small cap in that order. So have you noticed a similar trend? Could you please share your opinion on this? What would be a ideal allocation for small cap for long term investors?
Okay. See, generally that happens because of confidence in the market. So what happens is, because large caps are liquid, the traders, there is a big trader segment in the market, who trade. So they keep on moving fast in and out of small caps. Also, the money deployed is larger in large caps. So first that comes into market, then comes mid cap, and then comes small cap. Small cap investing is a lot to do with confidence in the system and not just numbers, because these companies are highly dependent on economic cycle. So that is why it takes little, their recovery in stock prices little lagged. Once large cap do well, economy stabilizes, and then there is a confidence in the system, then only small cap start performing. And I think that has happened all the time, and it will continue in future also. The small caps are slightly more risky than, for sure. So one need to be very careful. Now, coming to how much small cap an investor, I think that can only be answered by the investor himself. So there are two things, that keep in mind before investing in a small cap is that, one, for us at least, a small cap requires to give you decent returns. In 1 or 2 years, it may give you good returns by chance, not by design. To get a decent CAG to 7 years. Now, second thing is that you need to go through a lot of volatility as investor in small, because fall by 25%, 30%, pretty common in a small cap. So if you don't have that stomach or that appetite for that volatility, small cap is not going to be good place for you. Because what will happen is you may invest in a small cap looking at returns and expecting good returns. But when volatility come, you may lose your patience and you may be scared and you may get out. So then you can never realize a good return, and because small caps are very volatile, their movement around their average is quite high, their standard deviation is pretty high. So they move pretty in very large delta. So minus 20, minus 25, minus 30 is pretty common in a small cap. So if an investor is comfortable, then only he has to invest in a small cap, and only that portion of his portfolio, whatever it is, depending on his understanding, his appreciation of risk and volatility, and his return expectation, uh, only that much amount of money should be invested in small cap, where he's comfortable with the volatility and which he can leave for 5 7 years. I would say more of 7 years. So it's a very unique question, unique situation to every investor. So lot of things depend on his cash flow, his earning profile, how much time he has, etc., etc. So not a very straightforward answer that I have.
Sure, Anupam. So the next question is, you had mentioned that there would be a set of sectors that will expect a quicker recovery, and for some sectors it can even take more than 4 to 5 quarters. So which are the sectors where you are expecting a rapid recovery, and which are the sectors where you expect it will take a substantially longer time to recover?
I think anything that you consume as a regular thing in life, we call them staples, like soap, shampoo, etc., medicines, or basic items like stationery. Whatever you consume in normal life, that will recover pretty fast, because that is where demand will come back pretty fast, and hence you will have a good recovery. And the late recovery would be delayed recovery would be for companies which are like hotels, running hotels, theaters, etc. And that is why you see the performance of pharma and FMCG has been quite good, because one was that they were not having zero sales. They were allowed to do selling, to do sales, to operate, so that people have all the essential thing. And hence, unlike other sectors where actually the revenue is zero for some companies, here you have some amount of revenue, so some part of cost is recovered, and hence you don't need to fire people. You don't. There is no disruption per se, which cannot be reversed quickly. Since you are operating, you have not shut down your factory, you have not stopped completely supplying to your dealers. It is easy to ramp up, for some sector which is completely closed, and let's say for example a theater or a hotel. If it is completely closed, your staff is gone, it will take little time for them to come back, restart everything, all those things, reset up. So from that perspective, I think FMCG pharma is something that will recover pretty fast, and it's reflected in stock prices also.
Okay. Yeah. So one more thing with regard to these trends in the past, the data says that when markets have recovered and come out of a recession, there have been many instances where small cap funds have posted a significant alpha within a single year. Like for example, there were instances, say in 2009, there were instances in 2014 when small cap funds had provided more than 70, even 80% returns within 1 year itself. Do you see this as a possibility in small cap space over the next 3 to 4 years? Is there a chance of this happening? What is your opinion?
It's very difficult to predict in future and how much return we can generate, and that is why we just suggest people to only come to equity if you have very long term horizon, because then we will have a fairly decent idea how things will pan out. It's much easier to make a longer term guesswork or forecast or estimate that rather than very short term. And another thing is, that forecasting has never been a very useful tool for market. So I would suggest uh, people should take more of a historical perspective uh, and see what happened in past, and then take a clue about future rather than just trying to forecast. And in short term, I think there would be huge volatility that we have to live with it.
Okay. So there are generally two schools of thought for equity investments and more so for small cap. So there are one set of advisors who recommend staying invested in small cap for a prolonged duration, say it could be 10 or 15 years, whereas many other advisors generally look at small cap as a tactical allocation where over a 3 to 5 year period, once returns are accumulated, there's some form of diligent profit booking or asset allocation strategies that are deployed. In your opinion, what would be a better approach for small cap as a space?
I think both approach are good if you can execute it better. The real challenge in second approach, having a tactical view, is that uh, what is the chance of you successfully executing it? If you can really do it and you are disciplined enough, I think it's a workable approach. There is no problem in it. So as I said in my opening remarks, that you invest in bad time, sell in good time, just sit tight, wait for another bad time. Then don't be greedy. Unfortunately, the problem is that when markets are going up, they are giving you great returns, then you become little greedy and you don't come out and you put more money into it, and then market goes for a downturn and then you incur loss. You become psychologically disturbed or perturbed, you become sad, and then you don't invest. So I think that is the bigger problem in second strategy, that how you control your greed and fear. If you can do that, then your second strategy is pretty good.
Okay, so a lot of this has got to do with investor emotions, right? Like, say, for example, in 2017, when small cap as a space gave extremely good returns, it might have been very difficult for an investor to book profits and exit. So they might have held on for maybe a couple of more quarters expecting, but then since 2018, small cap has been on a downside trajectory. So you would recommend
Yep.
this is a good way to allocate funds, and this is a good strategy to follow, provided investors are able to control their emotions. So emotion should be left out of the picture.
Yes, yes,
Okay.
yes. And one thing we need to understand, that anything in the world uh, which is beyond normal ranges, whether it is positive return or negative return, it is exceptional. And exceptional means it will not happen every year, right? It will happen once in maybe 5 years, 6 years, 7 year time frame, or maybe once in 10 years. So one should understand what is exceptional and what is normal. So normal is, let's say, 500 to 700 basis point over and above your inflation, and generally from a perspective of equity return. And then you may have some slightly higher risk premium on top of it, let's say 200 to 400 basis for a small cap, because they are highly volatile. Any year where you are getting a larger than this, it is exceptional. It is not normal, positive or negative. So it will normalize. And normalize, if you are getting a 40% return in 1 year, 20% CAGR or 15% CAGR, you need to have a negative, right? That's simple mathematics. So from that, investor has to appreciate that over a period of time, everything normalizes. So don't give too much importance to exceptional time frames or exceptional years, both negative and positive. For example, a COVID-like situation generating such a negative return, it's an exceptional problem. It will not happen every year. Same way, as you said, 2017, that was an exceptionally good year. So it will not happen every year. The reality lies somewhere in between. And I think investor has to appreciate that and act accordingly.
Sure, Anupam. Understood. So I think we'll come to the final question. So what are your thoughts on passive versus active investments, especially in the small cap space? Because a certain set of index funds have been launched recently, and we can expect this moving forward. Do you feel that there's a good potential for alpha generation via the active route, specific to the small cap space?
Yeah, I think in small cap space, the only route is active route. It's very difficult to do a passive route, in my opinion. And you can see the data. one should not fight data too much, I think, and we should look at data objectively. If you look at last 10 years and look at small cap funds, I think as an industry, as a whole, as an asset management industry, a lot of people have generated decent amount of alpha over index in a small cap. There is another thing that investor has to keep in mind while doing passive in the small cap. That small cap index is really a screwed up index, because anything which is very good, it moves to become a mid cap and a large cap. So if there is not sufficient inflow of good companies which are now coming to and becoming a small cap, your small cap index is actually a very residual bad thing. And that is why I keep on saying that one should not look at a small cap index with too much of enthusiasm, because it's not very relevant. It is relevant just from a perspective that what is happening in the universe, to get a feel of it. But don't rely on too much, because there are really very, very bad companies out there in that index, which I think no investor will ever buy. So when you are doing a passive investing, you are owning certain companies which you don't want to own. So and they will not be growing, they will not be in a very good competitive positioning. So from that perspective, I think index investing in a small cap, I would be still very, very circumspect about it. In large cap, it may work. Not even in mid cap in India, I would say. In mid cap and small cap, there needs to be a lot of bottom up work to be done. And that is why you see, one should not look at 1 or 2 year of underperformance vis-a-vis index for the industry as a whole, because another thing is that when you have a big fall, generally your history also gets disturbed a bit, that your 1 year, 2 year, 3 year return also look bad. You have good time, your 1 year, 2 year, 3 year, everything looks good. Happens in bad time that people keep on mentioning more underperforming index, etc. But you have to look at this data, that in last 10 years, how many times perform, how many times they outperform, and the relevant time. So if you look at the data, and it's the data of active managed funds, especially mid cap and small cap, in a relevant time frame, at let's say 3 year or 5 year rolling, or in a 10-year block, and then see in how many years actually they underperform, how many years they outperform, then you will get a proper picture, rather than saying in just 1 year of performance. So from that perspective, I think there is still a big case for active investing in mid cap and small cap in India.
Okay, sure, Anupam. So we'll just have one more question, one final question from an advisor. So what are the steps you are taking while selecting small cap stocks at this point? Since future earning estimates might not be very, very relevant, you might have to focus and emphasize more on solvency. So are there do you foresee any chances that some stocks in the small cap funds might have to file for bankruptcies and might have to take drastic action?
So as of now, we don't see any possibility of any of our company filing for bankruptcy. Generally, we prefer debt-free companies, and wherever there is debt, we prefer companies with clear assets to back those debts. For example, we have Brigade or we have Chalet hotels. There are clear assets behind those to match the debt number, and they are physical assets. It's not like they are some invested in some working capital or some project. They're created assets. So from that perspective, we are comfortable. Generally, we follow the same philosophy, and we are still following the same philosophy which we follow. We look for good promoter, good business, then we look for good business cycle. Unfortunately, right now, business cycle for everybody is negative, so it becomes very relevant data. But certain time it will recover. At some point of time, it will recover, and we have to see that whether the recovery for companies that we want to invest in is fast enough or not. And fourth thing is that we look is valuation. So are we buying something at a reasonably sustainable long-term valuation or not? So these four things we keep in mind while buying a small cap stock, and we will continue to do so. Same thing. So there is not too much of change in our strategy. We are just trying to think that which are the companies which are capable of surviving and growing even after shock of COVID. So that is the only added question that we are asking as of now.
Sure, Anupam. So that's it for today. I think we can wrap up the question answers. So thanks again for your valuable insights and patiently answering the questions. So thanks for taking time off for this session. And
Thank
to
you.
the
Thanks a lot. Thanks for having me here.
yeah, it's a pleasure is ours, Anupam. And to the audience, so hope this session was useful. So we will be conducting more such knowledge sessions in the coming weeks as well. Thank you for participating.